All right. Well, hello, you guys, and thank you for joining us for today's webinar. We're going to talk about financial year-end planning and goal setting for next year for 2020-21. I'm here with Janae Wolf, also from Lerner Financial Group, an advisor here, and Austin Fitch from Horizon Investments. And we're excited to be with you guys today. Again, with kind of a new topic. We're going to build on the 5-minute financial plan discussion that we had the first time that we presented to the group, and then we're going to put in there what to think about as we come to year end and how to set goals for next year. So looking forward to that. Couple of housekeeping items. We are recording today, so we're going to send this out to you guys if there's anything you missed or to share with the rest of the group that weren't able to attend. We'll get that sent out along with a couple of documents as well. Also, if you have questions, please use the chat box, as we will be checking the chat box. If there's something that fits in where we are, we'll get that answered right away. Otherwise, we have some time at the end for question and answers, and we will answer it at that point in time as well. So at this time, Austin Fitch, again, like I mentioned, is from Horizon Investments. They're one of our primary partners on the investment side. They're also the group that helps us manage your TIA and Fidelity accounts for those of you that work with us here at Lerner Financial. And we truly appreciate our partnership with Horizon Investments. We both have a real goal-based planning focus, a real team focus on our investing and our financial planning process. And so they're a great partner for us here. So I'm going to turn it over to Austin. Austin's going to talk to us quickly about what's going on in the market and how that not only impacts us now, but how it might impact us moving forward. So take it away, Austin.
Awesome. Thanks, Nick. And thanks everybody for jumping on today. Really excited to be with you guys. And I jokingly told Nick when he asked if we could be on and just give a brief market overview. I jokingly told him that there probably wouldn't be much to cover at all, that there wasn't much going on in the markets these days. But as we all know, that is about as far from the truth as possible, as 2020 has absolutely been one of, and in many different facets of life, probably one of the craziest years that any of us has ever experienced. And the market would tell you quite the same, as we saw what happened in markets earlier this year. So March, when you had the market sell off almost 35%, as the world started to shut down in the face of COVID-19. You really started to see a market that got scared pretty quickly. But then from there, you've seen a pretty historic bounce back to where you're yet again at all-time highs on indices across the marketplace. So I've got a couple slides today that we'll use really just kind of guide my portion of the conversation. But as Nick mentioned, don't hesitate to put any questions in the chat box if there's anything maybe that we don't cover that you want to make sure that that you get our thoughts or opinions on. The first thing, and this probably shouldn't be terribly surprising, is kind of the virus and the pandemic itself. Just understanding from our perspective, and again, everything I'm saying here today is strictly looking at the world through kind of an investment perspective. So that's not to look at it from a social perspective. I know we'll touch on politics in a little bit, but really at the end of the day at Horizon, we look at the data that's coming in, whether it's around the pandemic and the virus and the vaccines, whether it's politically or geopolitically driven. We're looking at all of that to understand, hey, what does that do at the end of the day to the clients' portfolios for which we're managing money? And the first thing that we'll hit on is that the vaccine itself is really what you've seen, and the prospect of all of the vaccines that really we're expecting to see has been what's moved markets, I should say, over the last call it probably at this point 2 months. And I've got a graphic up here that we got from one of our research partners, Barclays. And I think it actually does a pretty good job of just highlighting how much work is being done in the pharmaceutical space on a vaccine for this virus that has, and as I mentioned earlier, in essence, basically shut the world down in many facets for going on almost 9 months now. What you'll note is that there's 2 different waves of kind of that vaccine coming. Obviously, we've all heard and probably seen the Moderna, the Pfizer, the AstraZeneca news over the last couple weeks, call it month now. I think the good news is that you're probably going to have vaccines in the population, even if it's a small portion of the population, but you're going to have something out there before the end of the year that's again being used on frontline workers, on folks that have pre-existing conditions, maybe the elderly, the areas where there is absolutely the most need. But the other piece, and this is I think what the market's also taking into account, is that there are a number of other companies in process in terms of vaccine creation and the FDA process for getting that approved that we expect actually probably, I would say at the very latest by the middle of next year by many of them. And again, all of that is extremely important because at the end of the day, the market's looking at when does business, when does the global commerce side of things begin to get back to normal? And what I would tell you is normally markets are considered forward-looking, meaning they're not necessarily taking information that comes out today and making a decision on how things need to be positioned within a portfolio. Markets tend to look anywhere 3, 6, 12 months out into the future. And what that would tell you is, and I think we would all hopefully, fingers crossed, agree that 12 months from today, we'll hopefully be living in a very different world, in a world where maybe vaccines are readily available by, pick your number of different providers or different companies that have vaccines available. All of that is extremely important for the markets. And again, that's, I think, what you're seeing from a market movement standpoint is the market really is looking out and saying, okay, if we can just, hold on, if you will, for another 6 or so more months. And what I would tell you, and we've had maybe this optimistic view for probably almost 6 months internally, is we actually have a gentleman on our investment management team who in his early days in the industry was a healthcare analyst. So he did actual individual company research for healthcare companies. And his quote to our team was that he has never before, and he's been in the industry for over 30 years now. And his quote to our team was that he has never before seen this many companies, and not just small companies, big name Fortune 500 companies working towards a solution for the same problem. And again, you see it on the left-hand side. It's not companies you've never heard of. It's companies that we're all familiar with. It's Pfizer, it's Johnson & Johnson, it's Merck, it's GlaxoSmithKline. These are all, again, global pharmaceutical companies that are all working towards a solution for the same problem. And I mentioned the idea of us being optimistic for some time. I think that goes exactly to what we've seen there. And the outlook that we have for 2021 when it comes to a market that is viewing global economies starting to get back into more of a normalcy, if you will, in 2021. Hopefully, at first part of the year, but again, at the very latest, we would expect it by about the middle of next year from an economic perspective. Now, that's not to say that maybe we don't still have to wear masks, that there aren't, certain precautions still in place, but it's the idea that we can go back to, and go out to eat. We can go shopping. We can do things that have unfortunately we have not been able to do nearly as frequently in 2020 as we otherwise normally would. So again, that's the prospect of these vaccines is absolutely one thing that has been seen as a positive. The other that I think is maybe completely underappreciated by probably the general population is just the amount of stimulus money relative to the size of both GDP, so the amount of size of the economy, if you will, but also relative to the size of anything that we've ever seen historically. So on this chart, this is a survey, this is data from McKinsey and Company, which is a consulting company. And they looked at the stimulus response in 2020 relative to the stimulus response that we saw in 2008. And they did it as a percentage of GDP, so it's kind of comparing apples to apples. And what you'll see is that the stimulus that we've seen around the COVID pandemic really dwarfs any stimulus response that we've ever seen from global central banks. To the tune of, in Europe, you're looking at stimulus response 10 times greater than what they had in 2008. In the US, it was almost 2.5 times greater. But again, that just speaks to the amount of liquidity that's being put into the system from central banks. And again, what I would tell you is that should only serve as a tailwind once the vaccine really starts to take effect, because not only will you have an economy that's coming back online as we get later into 2021, you'll also have this money that's really just sitting there to, again, it was there to protect against kind of the pitfalls of a globally shuttering economy. But as you get out of that and you still have that money sitting there, it's only a tailwind for the near term. Now, we can absolutely talk about the longer term effects of kind of the balance sheet, the amount of debt that is on that balance sheet at this point, the trillions of dollars that eventually will have to come off that balance sheet. But what I would tell you is good, bad, or indifferent, that's unfortunately a problem, probably honestly even for the next generation of investors. That's probably an issue that doesn't really get addressed for at least probably close to 10 years, if not longer. And what I would tell you from a market perspective is, while the market is forward-looking, it's not that forward-looking. It's not looking out 10 years from now and necessarily pricing that in. So again, if you think about from a portfolio or a market perspective, seeing that type of liquidity in the marketplace that is available for market participants, for individuals, that is absolutely a positive just from a stimulus perspective in terms of stimulating growth as we head into 2021, not only from an economy perspective, but also from a market perspective. The last piece that I do want to talk about is really talking about interest rates. And this is one where we could absolutely go in a lot of different directions. But I would tell you, most folks on today's call have probably seen whether it's their mortgage rate or whether it's maybe there's a business loan that you're involved with or you're aware of. I would tell you that interest rates, as we've seen, at the beginning of last year, really, from the Federal Reserve, have been slashed to basically next to zero. And again, that has happened before. It obviously happened in 2008 in the great financial crisis. But what's different this time, and I would say I hesitate to say that normally, but I think this chart paints it into a pretty stark difference, is that the expectation for those rates going back up, meaning that and typically rising interest rates can be a headwind to business because it means things are more expensive. You have to fund that with interest payments, right? But what you'll see is expectations for interest rates today are expected to be low for not just a year, not just 2 years, but upwards of like 10 years. So I would tell anybody on today's call, if you feel like you missed the boat on refinancing your mortgage, I can pretty confidently say that didn't happen. That you still have plenty of time, and honestly, rates may remain this low for years. And what that means is a couple things. One, that actually helps. So we talk about the debt on the central bank's balance sheet. Actually helps from a debt service standpoint. So again, that's part of the reason that's not going to, the debt on the balance sheet is not going to be as big of an issue as maybe it otherwise would have historically, is because the debt that's been issued and what's currently being paid is a fraction from an interest coverage or from a debt service standpoint as what it's been historically. But the other side of that, from a 2021 perspective is if you think about kind of cheap money, and what I mean by that is if businesses want to get loans, if they want to go out and fund a new project, or if they want to hire additional staff, and they want to take on some form of debt to do that, with rates being as low as they are, it actually gives them a lot of flexibility in terms of how they're thinking about that and maybe how they finance that. And again, the risk is that they get in, businesses specifically would get into some sort of, I should say, trouble down the road with interest rates starting to rise eventually. But as you can see on this chart, that's probably not something that we're terribly concerned about in the near term. That's something that, as we're looking at the markets, we're aware of and we're absolutely monitoring. But that's not something that we think is a big risk as we head into 2021 specifically. Maybe it's an issue as you get, if rates rise a little bit quicker as you get into 22, 23. But honestly, and this is a conversation that we've had internally, honestly, you're probably not looking at really even rates changing much at all during the next 4 years, which I know we have not talked a lot about politics today, but what I would tell you is you actually have an environment for the incoming administration where the central bank side of things and the Fed policy side of things actually may be a non-issue for Biden, at least for the next 4 years that, obviously that he's set for. So that'll be a really interesting phenomenon. That'll be something that we're watching as well as how does policy from the Fed, which again is fairly or expected to be fairly non-existent, how does that merge, or how does that combine with policy legislatively? And I think that's something that we continue to watch. I would just say as an aside, I think markets actually took the election outcome pretty favorably. I know we've talked a little bit, and I know we did a call with Nick and team, I guess right before the election, about potential outcomes. And I would tell you kind of the outcome that is most likely, obviously we're still waiting on the runoffs in Georgia to determine majority in the Senate, but the outcome that's most likely is the idea that you get this split government environment where the Democrats control the House, the Republicans control the Senate, and then obviously you have President Biden in the White House. That divided government where the Republicans still have kind of a voice, if you will, that they can't be overshadowed in that sense. It is actually a good thing from a market perspective in that it's not going to be one party either way dictating terms entirely. It's going to have to be, if for things to get done, there's going to have to be compromise. And again, markets generally view that as favorable. I would say, and again, not talking socially about either side, markets are somewhat hesitant if one party is in power of all three of those all three of those components, so the House, the Senate, and the White House. But again, what you're seeing with that divided government is actually viewed fairly favorably from a market perspective. So with that, I'd be happy if I haven't seen any questions come along just yet, but if there are any, happy to take those. Otherwise, I will turn it back over to Janae, as I think she is going to walk through the 5-minute financial plan.
All right. Well, thanks, Austin. Yeah. So this is our 5-minute financial plan. A lot of you have probably seen this before if you've done one of these calls with us, but we thought we'd just kind of go through it briefly here. And then Nick and I will touch base a little bit on how, looking back at 2020 looks, and then looking in the future at 2021 looks compared to this 5-minute financial plan. So the whole idea behind this is that it's really just a bird's eye view of the financial planning process. So our whole idea is we just don't want you to have to worry about money. And if we have a process in place in order to, whether it be saving or investing and all those things, if we have a process in place, it helps to alleviate some of that stress that we know money can cause. So it kind of all starts with account A, and this is our cash flow management account. So what we mean by that is, you get your paycheck, it comes in, whether it be biweekly, monthly, however it might be, and then it goes out right towards those monthly expenses. So these might be all your fixed costs, like maybe you have a mortgage, your utilities, your car payment, all those things that you kind of have to pay every month. But what's also included is any of those lifestyle costs. So maybe you like to take your family out to eat once a week when we're not in a pandemic, I guess, but takeout in this case, or maybe you have a gym membership or any of those things that are included in those lifestyle needs. That's also in account A. And with that being said, so account A is pretty much our checking account. And then we move to account B, and account B is more of that savings account. So there's really two parts to this, one being your major expenses. So a great example this time of year would be Christmas, right? So you're not really buying Christmas gifts every single month. So it wouldn't be included in that account A because you're not doing it monthly, but we want to make sure that, come December, or if you get your shopping done or early in November, that you have funds set aside in order to buy those Christmas gifts rather than having to dip into your savings elsewhere. Also included is that war chest. So you might have heard maybe emergency fund or rainy day fund. So we recommend about 3 to 6 months worth of expenses in this account. So that's really that account A. Whatever that account A budget, monthly budget is, we recommend having about 3 to 6 months worth of funds earmarked for emergency purposes, right? Life happens. We know what's going to happen. We don't know when or what, but we know that sometimes things happen out of our control. And our whole point is that we have a nest egg of money set aside. So remember, we don't want to stress about money. So that way, when those things come up, we can just take the money out of our war chest. We know we saved it, and then we can just work on replenishing it. So if most of know, your money in your savings account at the bank is probably not earning much, especially now. So that's kind of when we start looking into account C. And we kind of title this our midterm investment. This is really where we get your money start working for you. Another term that I like to use is call it your fun account. So this is the account that helps you buy that cottage on the lake, or maybe that dream car. Maybe you want to send your kids to college. So all those fun things, not necessarily earmarked for retirement, but kind of that middle of the road. That's kind of our account C. And we say we want about 3 years plus funds in here. So we don't want to have to touch these funds if we need them within the next 3 years. So this account C is earmarked for any 3+ year expenses that we might have coming up. And why 3 years is because we all know the market can be volatile, right? 2020 was a prime example of that. So really, if we know the market's going to be volatile, we just need about 3 years in order to capture that uphill trend of the market. We can invest in anything from mutual funds to stocks to bonds within this account, but the whole idea is it's kind of that midterm investment account. With that being said, we kind of move down into account D. And account D is our long-term investment. So a lot of you have probably heard of these. You've seen them, your 403B, maybe you have an IRA or a Roth IRA outside of work, maybe an annuity. So account D is really that long-term investments, or in other terms, it's your retirement accounts. There's some exceptions, but for the most part, this is that 59.5 money. So it's kind of earmarked specifically for retirement. The goal is to put money in there, not touch it until retirement. Whereas account C is kind of that middle of the road account. So if we look at, account A, B, C, and D, that's really like our offense for the 5-minute financial plan. So we can't really have one, without the other. They all kind of back each other up. So if we don't have a proper war chest in place, for instance, and our roof leaks on our house, right, we're going to have to start digging into whether it be our retirement savings or things like that we don't necessarily want to do. So that's why we kind of make sure that we want to have them all in order and all lined up there. With that being said, every offense needs a defense. So when we talk the defensive side of the financial plan, we look at, starting the living too long. So it's kind of funny to think about that, hey, I might live too long, but in reality, let's say you're thinking about retiring around 60, right? And statistics show there's a good chance you'll probably live into your 90s. So that's 30+ years of income that we'll need investment saved up for, because you won't have employment for that 30 years. So that's where we just want to make sure that that nest egg of retirement money is really set aside and it's there when you need it, in the right amount that you need. with that being said, we also have our dying too soon. So, these aren't the fun conversations, but these are what happens to my loved ones if something were to happen to me, and what happens to my stuff. So if something, a lot of you probably have family. So if your family relies on your income and something were to happen to you, how does their lives change? So that's usually the discussion we have with life insurance, to kind of bridge that gap. And then what happens to your things? What happens to your house? What happens, to your car? What happens to that retirement account we just talked about, or maybe that account C, your bank savings, all those things. We want to make sure that, and that's usually done through estate planning. So we usually want to make sure that all that stuff's in place just in case. And then we also have becoming sick. So a lot of you probably recently had open enrollment. So a lot of times health insurance is covered through work. But we just want to make sure, you review that, make sure you're enrolled in the right plan for you. And like I said, that's usually through the employer. If not, you can get it elsewhere. And then becoming disabled. So for a lot of us, our biggest asset is actually our ability to work, right? It's our ability to get out of bed in the morning, go to work, and bring in income. It's our future earning potential. So that's covered through disability insurance. A lot of times the employer has that benefit. Again, if not, you can get it elsewhere, but we just really want to make sure you're covered there, because a lot of times, and believe it or not, your likelihood of becoming disabled is a lot higher than your likelihood of dying too soon. And then last but not least, we have our long-term care. So really what this is, it's insurance that you can purchase in order to help the cost if you were to go into an assisted living or a nursing home in the future, if you can't do this, if you need assistance in that area. So that's I went through it fast, but wanted to give a brief overview and a brief touch on it for those of you that's seen it before, of the 5-minute financial plan. And then Nick's going to kind of incorporate how that looks at year end here.
Perfect. Thank you, Janae. And like Janae said, this is kind of our home base for everything we do, financial planning. So when you look at different pieces of the puzzle here, and that's why we put it into this 5-minute financial plan. These are the different things to look at when we come to year end. These are the goal setting sessions, maybe, or review sessions that you're either going to have with your advisor and or with your spouse. Some of you guys may do it on your own, or you have an advisor that helps you with it. So when we look at account A, that's your cash flow, budget review. Budget can be seen as a B word, but it's one of those things. That's why we use cash flow management. But making sure that what we planned for the year matches up with what actually was spent. So matching that budget to actual, is really important. We get to the end of the year, because you want to see how close your budget was. Especially, the fixed costs are the fixed costs. Those aren't going to change much. But those things like a dinner out here and there, or entertainment, or or something like that. Those are the things that can really catch up and bite you, come year end. And so you want to see where you stand. Austin mentioned where interest rates were, and those are going to continue to be in that range. And it's a great time to refinance, right? So looking at everything that falls in account A, including your fixed costs, and is there any way to reduce those fixed costs? One way to reduce your mortgage payment is by refinancing at a lower rate. Maybe it doesn't reduce your payment, maybe it reduces the years of payment. So either of those things, whether it's reducing the timeline of your mortgage or reducing the payment of your mortgage, both good to check. And then withholdings, again, another thing that impacts your paycheck, something to get with your accountant on, but make sure that, has your dependents moved on? Do I need to change my withholdings? Is there anything there? If you're getting too much money back at the end of the year, that might be a good thing to readdress, to maximize what's in your paycheck, that route. Account B, the savings account. Are we in a situation where, maybe a goal of ours was to increase our savings? Were we able to do that? Did we meet those yearly goals that we set from this account? Account B is really the account, or a great account to, kind of set those year-end goals. And, if I look back 12 months from now, this year was a great year because I did A, B, and C. You know, and you know, it's interesting to think about, you know, those things, you know, maybe you don't think of it as having a monetary value, but a lot of times they do. You know, you think about being healthy, that may have a monetary value. You think about traveling more, you know, a lot of times that's going to have a, you know, a monetary value. Even if you're just driving, you know, it's still going to have those things. So setting goals and making sure you meet those goals in that account are great to do. And then charitable contributions. So many of you guys are very charitable. And we live in a community that really benefits from that. So making sure that those are things that you're still able to do, right? That your charitable contributions still meet your goals, still fit into your cash flow is really important on a year-to-year basis. And, you know, is there anything there that you want to adjust? Account C, you know, Janae hit on this a little bit, but, you know, account C is kind of the midterm investment plan. It's also a plan, you know, if you want to retire pre 59 and a half, this is a great place to be investing, because this money you have access to pre 59 and a half. So, you know, if it's not something you have, you know, is this something maybe we're interested in setting up, because we want to, you know, we want to start putting money away for different reasons. So if it was a goal of ours to get account opened up outside of our retirement account, did we do that? And how did it do for us? And then in your retirement accounts, and this is where, you know, you're going to catch a lot of the things. But you know, at the end of the year, did we max out our Roth IRA contributions? Maybe we're converting an IRA to a Roth IRA. Have we been able to make that happen? And we typically, you know, will communicate with an accountant on that to see where you are as far as your income tax. You know, your income tax range is there, and does it make sense to convert some of that to Roth IRAs? We review our beneficiaries. Again, life happens, things change. You know, is there anything that needs updated or adjusted with our beneficiaries? And then, you know, our portfolio. Did we accomplish the goals we had based on the portfolio that we set out? You know, we may, you know, especially in a year like 2020, you know, hey, you know what? I don't want to work until 65 anymore. I want to work until 57. You know, I need to, you know, does my portfolio still meet those needs? Maybe we need to be a little bit more aggressive. So anyways, those are the things that you want to look at the end of the year. And then when you go to, you know, life's what ifs there, the dying too soon, again, you know, look at beneficiaries. You know, is everything still where we want? And then estate plan. You know, estate plan review isn't necessarily something that you need to do every year, but it's something that you want to do, you know, on a regular basis. Again, life happens, things change. You want to make sure that your plan meets your needs, because we don't know, right? I mean, that's why you have these things in place, is to take care of those unexpected things. And so you want to make sure that everything's going, you know, going where you'd like it. And becoming sick, spending down your flex spending account. So many of you probably either have an HSA, a health savings account, if you have a high deductible plan, or you may have an FSA, the flex spending account, both put away with pre-tax dollars, but two totally different things. You know, the HSA you can carry forward with you. The FSA you must spend every year. Maybe some of you have gotten bitten by that in the past, but have we, you know, paid those expenses by year end that we need to pay out of that flex spending account, because you don't want to lose, that's use it or lose it money in those flex accounts. So have we spent those down? So those are the things that we're looking back on. You know, so, you know, when we get to year end, these are the conversations we're having. Again, hopefully you're having these conversations with a spouse or your advisor or us, if that's us. You know, and if you're not, we'd love to be that sounding board and help with those. But you know, these are the kind of things that on a year-to-year basis you want to make sure you're looking back on, so that you're meeting your goals on a move forward. So now, you know, when we get to the end of the year, there's making sure that things happened and we were able to do those things that we had planned on from the previous year. And then there's planning for next year. You know, I hope that 2021 is a heck of a lot better to us than 2020 was. And I want to make sure we're setting goals that meet that. So Janae's going to talk about setting those goals, and similarly to this, looking at in review is looking forward and what's to come.
Awesome. Well, thanks, Nick. And, just seeing 2021 up there makes me happy. So I don't think it can be here soon enough. But yeah, so, when we look at 2021, so when we're looking at the next year, when we talk about account A, really what we're thinking is we need to update our budget, right? So like Nick said, it's kind of that B word, but you looked back through this year and you said, okay, where was I supposed to be? Where was I at? And now what does that look like for next year? Are things changing? Did you, maybe you did refinance the house, and so now your payment going forward is less, or maybe you purchased a new house, you have a mortgage, or maybe you paid off that car. So, your budget looks a little different. You don't have that car payment anymore. So all those things change from year to year. So just kind of take the time, sit down and update that budget for 2021. And we highly encourage incorporating savings right into that monthly budget. So like we said, the whole idea behind this is so we don't have to stress about money. So if we know we have a plan in place and we're kind of incorporating that savings right into our monthly expenses, it makes it real easy to kind of out of sight, out of mind kind of concept, right? So, and then when we look at account B, our savings account, like Nick said, it's really our goal setting account. So if I asked you what are 3 things that you could do in 2021 that would make it a good year, what would they be? Like Nick said, sometimes we don't even think that goals will have a financial side of it, but for the most part, they usually do. He used the example of being healthy, which is a great example, right? If you want to be healthy, maybe you will need to get a gym membership, or we all know it costs more to go to Panera and get a salad than it does to go to McDonald's and get a double cheeseburger, right? So just those kind of things that we always don't consider having financial impacts, but we want to make sure that, you're setting those goals. We want 2021 to be a good year. So just kind of get those written down. We encourage you to kind of hold yourself accountable there. And then also plan for large expenses. So maybe you need to repair the roof next fall, or you want to put an addition on the house, or whatever it might be. We encourage you to have that earmarked account set aside for that. That way, when it comes to it, it's not a surprise and you don't have to, pull from any other investment accounts. With that being said, it's also good to review that war chest. So that rainy day fund, did we dip into it a little bit last year? Did we not? And for 2021, just make sure that we're replenishing that and keeping that up. Or maybe our goal is to work to build that up to that 3 to 6 months worth of account A. So just some things to look forward to in 2021. And then, when we go talking account C. So like I mentioned before, this is that midterm investment account. And what account C really does is it adds diversification, right? So it's more flexible. You can take the funds out without penalty. It's not, like account D, which is, specifically earmarked for retirement, has a little more flexibility. So there's no time like, the beginning of the year to start new habits. And a great thing to do if you haven't already is to start that account C. Maybe you've been working on your retirement plan at work, you have your savings there, you built your war chest up, all that stuff. And now it's you're just missing that middle of the road account. Now's a great time to get started on that. A great idea in account C2 is college savings. So maybe you have some kids or some grandkids or some loved ones that you would like to help fund college savings. Now's a great time to kind of review that and start saving for that as well. And that would be a account C earmarked account as well. With that being said, we kind of move down to account D. This is those retirement accounts. So if you haven't already, a great opportunity would be to open a supplemental 403B. This is a great way to save kind of that systematically. So like I said, you don't really think about it. It's kind of out of sight, out of mind. The money just comes from your paycheck, it gets saved. And it's a great systematic way to start saving for retirement. So highly encourage that if you haven't already. And if you have, maybe kind of reevaluate what 2021 looks like for you. Maybe you could possibly increase those contributions, right? So kind of sit down, take the time for that 403B and just kind of see if there's anything you can do there just to kind of help increase those retirement savings. And then, in addition, Nick touched on this briefly, but there's the Roth IRAs within the account D. If you're able, the Roth IRA is a great option. It's a great piece because it allows for tax-free growth if used correctly. So that is a great opportunity. It is a little more, deliberate because you have to pull the funds from your checking, think to invest them, all that kind of stuff, rather than the supplemental 403B, which kind of happens through the paycheck. But it's a great way to get some after-tax dollars, get some tax-free growth for retirement. So, and then, the life what ifs, the defensive side of our 5-minute financial plan, looking into 2021, that update beneficiary. So we kind of looked at past year, 2020, did things change? And if they have, make sure you're updating those on the accounts. So whether it be, getting the papers changed or whatever needs to be done to get those beneficiaries updated how you would like them. And then, is your estate plan still meeting your needs? Is your life insurance still meeting your needs? All those things can change. Maybe you had another child last year, or any of those things that can fluctuate from year to year. We just want to make sure that your estate documents and your life insurance, the beginning of the year is a great time just to review and say, hey, is this still an adequate amount? Or, hey, maybe I need to get some things reviewed. So that would be a good goal for 2021, just to make sure all that's still in place, how you'd like it. And then, the HSA versus the FSA. So an HSA is a great piece. We, kind of use the term that it's the only triple tax advantage account, right? So money kind of goes in tax-free, and then if used for health, specific health expenses, then you can go ahead and use that tax-free as well. So it allows for that tax-free growth. It's a great account. Like Nick said, it goes year to year, whereas the FSA is kind of the use it or lose it. Now, keep in mind, you can't double dip. You can't have a health savings account and a health FSA. You can still have the child care FSA, which, is a great portion. Why not help pay for child care if you can on a tax-free basis? So we definitely encourage that. But with that being said, too, if you decide to take the FSA route, start funding that for the 2021 year. And what does that look like for you? It's always good to reevaluate, what 2020 looked like. Did you use the funds? Did you not? And then looking at 2021, maybe you have some larger expenses that this year needs to be funded a little more. Maybe you need new braces this year, or just a surgery out of network. Maybe this is the year that you purchase glasses, right? So any of those things that kind of come up, just reevaluate that situation for 2021 so we know you're in a good spot. I think that's pretty much what we had on the 5-minute financial plan there. I think Austin's going to go through and take some of your questions. So like we said, just put them in the chat box there and we'll try to answer as many as we can.
Absolutely. Thanks, Janae. And one question that did come across while we were going through, specifically around the 5-minute financial plan, the question was, what are some strategies for teaching this to others, i.e. kids, parents, etc., either that you guys have used or that you could recommend to the folks that are on today's call?
Yeah, absolutely. There's definitely a couple of different strategies there. When you're talking about kids, one of the best things that I've seen and heard and have started to even do some with my kids is, you have a savings rate, that you establish, or you kind of look up what a good rate of savings is, and you help your child save like that. So maybe, I get $100 from grandma and grandpa every year, for my birthday. How can we make that work? And so, one of the things is, maybe we put, I want to give 10% to charity. That's important to me. So 10% goes to charity. So we put $10 there. I want to put 20% in my savings account. So we take $20 and put it on our savings account. And then I want to invest, say 15%. And so I take 15%, maybe we put it in, a 529 account or an UPMA account or something like that, that mom and dad, you may have put away for the kids. But, it's just a good example to set for the kids. So if I get $100, here's all the things I need to think about when I get that. And you can do that same thing with 100, or you can do it with $20. I mean, it's all kind of the same. But that one is really good, I think, just for developing those really good habits. The other thing that I've done with kids as well is have them come in, to your meeting with, with us or your advisor, whoever that may be, and have your advisor talk to them about some different things. Maybe they got, they received some money for something. Again, maybe it's a birthday or something like that. But have an advisor talk to them about, some smart things to do with that, because like anything else, sometimes when you hear it from mom and dad too often, that's not your favorite place to hear it from. And so having somebody else mention it, can be a benefit, and when you parents, everybody's comfort level with money is different. For what may be taboo for some, others may be open for. Well, we're, family planning, whether that's whether that's with your kids or with your parents, family planning becomes really important, a really important piece for that, and being open. It's not like you have to discuss dollar amounts that are in your accounts or anything like that, but knowing, maybe different accounts you have and why you have them and your plan for them and your goals that you have that, for them. Those are important family discussions. And so I think, any of those things can be helpful, I guess. I don't know, Austin or Janae, I'm a little bit long-winded, but, anything else there?
Yeah, I would just say, to add on to that a little bit too is, we also would encourage you to move up the family tree as well. So whether it be, talking to your kids, that's great. And then also whether it be maybe talking to your parents or your in-laws and, just having those conversations with them as well. Like Nick said, it doesn't have to be numbers and specifics, but just a lot of times just opening those conversations and having an open door in that communication a little bit can help in the long run.
Yeah.
Awesome. Nick, one other question that came across. If I have some extra money in 2021 from income, how do I know where to put it or what's best to do with it?
Yeah, that's a great question. I mean, that's where that's where planning helps. It really helps. So, it depends what's most important to you at that time. Do we need to, help you increase your war chest? Do we want to think about retiring early? And so we want to save a little bit, in that account C, or maybe we're saving for a car or a second home or something like that, and account C is the best place. And maybe it's, hey, I want to maximize what retirement looks like, and I need to hammer down on my retirement account, whether that's like Janae mentioned, a supplemental 403B, which is really easy for you guys. It comes out of your paycheck, you don't have to think about it, or starting a Roth IRA, which are just great pieces to add to the puzzle. But that's where planning helps, because there are options for that. Having extra money is a great problem to have. That provides a great opportunity. And so, I think making sure that you're in line or in tune with your goals and what makes the most sense for you, becomes more important as you do have money, because, you don't want to get to the end of a year or the end of a quarter or the end of a month and say, man, I had this extra money, but now it's just gone and I don't even know what I did. I went out to dinner a couple extra times, or I bought this thing. Those are all good. It's all about balance, right? We want to make sure we're living life, but planning for the future becomes really important, making sure you're setting yourself up, like Janae said, to not have to worry about your finances. That's truly the goal.
Awesome. Well, Nick, I think that's it in the way of Q&A. So I will let you probably close us out here.
Perfect. If there is nothing else, we truly appreciate the opportunity to talk to you guys. We're open to helping however we can. If you guys ever have something that you want to learn more about or interested in hearing more about, let us know. We're happy to jump on here, whenever you guys would like. So we appreciate our partnership. On this end, I know Janae is excited to be working with you guys as well, and we're extremely excited to have Janae with our firm. So on behalf of Horizon Investments and Lerner Financial, thank you guys for being with us today. Enjoy the rest of your day. Have a happy holidays, and we'll look forward to talking to you guys again really soon. Thank you.
Thanks, guys.
Thanks, guys.
Thanks, Nick, Janae, and Austin.
You're welcome.